Welcome everyone to the Venture Capital panel. The aim of this panel is to give you insights into how to invest in Insurtech. We want to look at two perspectives. First one, looking back, understanding learnings from analyzing and investing in Insurtech, and then spending the second part looking into the future, learning from this really bespoke panel here how basically the investment thesis of the different funds and the underlying assumptions. So let me, before we start, actually as the start, let me quickly introduce the panelists here. Let me first start with Clemens von Bergmann, who is a partner at Alstin and also a sponsor, a very generous sponsor of this conference, making it possible also especially to have a lot of young people here. Then we have Rob Moffat in the middle, who is a partner at Balderton. He's overviewing companies such as Nutmeg and Wooga. We have Mike Lobanov right next to me, a general partner at Target Global, which is, has done very interesting investments. Among them are Fox and Clark, of the first wave of Insurtechs, and he's also a board member of ShareGain here in London. Then I would like to welcome Malcolm, who's a principal at Octopus Ventures. I'm sure you have all heard of Bought by Many. Will be interesting, maybe he has something to say to that. Imran from AXA Strategic Ventures, welcome as well. You have invested in companies like Policy Genius and One, so also quite a very interesting fund to learn from. And last but not least, Sam Evans, who has started his own fund, EOS Ventures. He has worked with multiple startups such as Neos or Right in Them. Thank you for being here. So let's use, as I said, the next 20 minutes to look back. What are your learnings? I would like to start with Rob and ask him, you have been looking in the sector for quite a while now, and it would be interesting to know why haven't you been more active in the sense of investing?
So yeah, it's now becoming a standard question on these panels is, am I the least active venture investor in insurance? Number of investments relative to amount of words spoken or written about insurance. I think part of that is this industry is developing very fast. I think people really started focusing and building Insurtech companies maybe 18, 24 months ago. And there has been a lot of development since then, but Balderton is mostly a Series A investor. We invest in companies that have a product out there. The product is starting to show that it has product market fit. We're starting to see some early metrics, and there aren't many companies that have reached that stage yet. So it's partly just a stage at which we invest. I think someone like Sam has been able to be much more active because as a seed investor, there's a lot more to do right now. I think the second piece is finding the right combination of a fantastic technology team, an attitude in the company that's about moving incredibly fast, and having people who understand insurance. And I think you need to have all three of those to get somewhere here. It doesn't mean you need to have the perfect combination of a 30-year experienced Lloyd's expert in combination with a 5-time tech entrepreneur, but you need to have that combination of skills. And I think trying to find that combination has been something I've been struggling to do. And the third piece is I'm still learning. This is an incredibly deep industry, and as a VC, you only start to scratch the surface of it. And I still feel like I've got a lot to learn.
Thank you very much. Mike, you being the opposite, or rather heavy investor into this first wave of Insurtech, having invested in Fox and Clark, have your expectations being met on these?
Yeah, Hi, everyone. Yeah, I would say that our expectations were met on that. More than that, we already exited from Clark. So an exit was always good for any VC, as you guys know. And we did a pretty good return on that, though it was a short investment. And on WeFox, I think we see a lot of potential going forward. We saw it was a very interesting idea, like how we got into investing in InsurTech, because I'm originally Russian. I'm coming from Moscow, and in Russia we had all the insurance tech, all the insurance companies going online back in 2010, 2011. So once we saw the trend in Europe, we definitely decided we should definitely be in that. And we started investing in 2015 and 2016 in it. And it was for us a no-brainer that this market will be big. It was a no-brainer that on German market, where the average German has seven insurance policies, definitely those companies should have a lot of value and should develop very fast. And we always try to look at companies that found a way to scale efficiently. Because, for example, the Wave 1.0, such companies as Clark, GetSafe, Kneep, and the others, they're just trying to go to customers directly. And I think that costs a lot. However, such companies as WeFox, they're trying to go through brokers, and that makes their customer acquisition costs much lower. So we always try to look at companies that have a leverage in customer acquisition. And once you find those companies, they definitely have everything to succeed if the team is right.
Thank you very much. Now I'd like to direct the question to both Imran and Clemens. We are obviously operating in a regulated business that possesses a lot of unfair competitive advantage when working together with an insurer, such as the amount of data, the relationships with brokers, low churn in customers. How do you see an advantage here, Clemens, having one of the most famous personalities in the insurance industry behind you as an investor?
Well, certainly that's a big advantage. The Altstein Fund is part of the Maschmeyer family office, and Carsten Maschmeyer was the guy who basically invented the independent financial advice, so not only selling products from one company, but taking the best of the market and selling it to people. It's basically what Check24 does in Germany, which is sometimes called the mother of all fintech companies. I was there as a managing director for 3 years after my stint with High Tech Gründer Fund, where I was doing early stage investment for 8 years to get some operational experiences. And when I started there, I learned that regulation is actually a good thing to do because it keeps the industry from the participants stable. It helps to build united markets. So if you look at huge economies like in Germany, with more than 80 million people living under the same regulation, going to the US, you have it state by state by state. So that's actually an advantage over here. At the same side, it helps to keep products fair to the people. So I think we could use more of regulation if it's done in the right spaces. But let me hand this over to my colleague here, who maybe has a different view.
I think I wouldn't disagree on the regulatory front. To your question about what's the value that the backer brings, right? So the way we think about what we do with the fund is two things, right? There's one piece of the usual VC investment advice and help, right? Like just helping people recruit a management team, helping them think about what it takes to launch a new country, what it takes to, the metrics people are going to be looking at, which we do the same as we did with any other. And then, the insurance industry has particular complexities, right? Like whether it's regulatory or others, and being able to have somebody you can go chat to about, I don't know, the regulatory process in Germany or building risk models, or even actually in other things that are just any big company, right? Like how do you think about cybersecurity? What's your disaster response? So I think we find that's helpful in the same way we do with lots of firms, but like obviously there's very close relationship with AXA to be able to just bounce these ideas back and forth and be able, when somebody has a question about something, to be able to get them to somebody who is actually an expert and has spent 20, 30 years looking at that and can just warn you about, okay, here are the things that will go wrong that you probably won't notice for another few years. And I think that's kind of the way we try to think about it, right? This sort of menu of things that when people are looking for help, you can connect them up.
One more thing to add to that, if you understand the industry, if you understand insurance, if you've worked in the space, you save your companies a lot of time explaining things over and over that are complex and complicated, but that just come with the business. So I've been selling actually insurances for almost 3 years by the thousands. So I have very close relationships with lots of the German and then also international insurers, and you tend to understand their problems. I give you an example. We wanted to have the insurance delivered to the customer right away. So something where you think that comes naturally and something where you say that must be easy. Well, you come to understand that there is certain multi-billion companies who cannot do that. It just doesn't work, and it cannot just be done. And one of the reasons is these companies have backlogs of IT tasks that are probably a year or something. Each of the tasks in there is very, very important, otherwise it wouldn't be in there. So you cannot just sneak in at the top and say, okay, let's print a PDF, even if printing a PDF is easy. Understanding that helps you very much getting a feeling for a startup, getting a feeling for how much sense it makes to talk to insurers, and also to know whom to talk to, where to go to, who is the right person in the company. And I think that helps you as a founder in being more successful and being quicker. So much to the backer, for us, it comes naturally that founders tell us after talking to us, okay, it's great to have someone who understands it. We don't want to explain it over and over again.
Thank you. Sam, now that the first wave of Insurtech is over, the second one is already here with more, let's say, B2B focused value propositions such as analytical platforms or the like. It would be interesting to understand how do you benefit from your insurance background and looking forward, where's this heading? What's the next wave going to be?
Yeah, sure. It's an interesting question, and I guess we were fortunate in the sense that we got involved in Insurtech right at the very start of this evolution. So we made 6 investments towards the back end of 2016. So I need to be a bit careful what I say because there's some great companies there, but it's clear that we're seeing the sector maturing, becoming more developed, more sophisticated. Actually, to go to Rob's comment earlier, our first investment has now raised a Series A, which is a NEOS smart home insurer that raised 5 million from Aviva and Munich Re. So we're seeing some traction on the funding side, but I think what's maybe most interesting, certainly from our perspective, is in the initial phase of Insurtech, a lot of the focus was around personal lines, distribution, and understandably so, because they're relatively simple products, easy to understand, and the customer sort of interface was relatively poor, so lots of opportunity. But now what we're seeing is that companies, innovators, entrepreneurs, are starting to look right across the value chain and also across product verticals. So we're doing a huge amount at the moment in the commercial line space, where the fundamentals for innovation are huge. So I think we'll continue to see more focus in B2B models or B2B2C, but looking at not just solving a customer problem at the front end, but working right the way through the insurance value chain, be it claims, Even some of the back office processes are very inefficient, and there's a lot of low-hanging fruit that can be gone after.
Thank you very much. Yeah, Malcolm, maybe you, from a non-insurance background, what is your take on that? Do you still understand this new wave of startups?
Probably relatively no. Actually, before I answer that, can I just see in the room who's working with Insurtech startup? Can you just put your hand up if you are? And can you leave it up if you found fundraising easy? Because one of the data points that's really interesting when looking at industries is how much money's going into it. And Insurtech's interesting because actually it's got quite a large share of voice, but actually quite a small share of wallet when it comes to investors. So if you think it takes funding teams, great business models to build businesses that you can start to invest into, to Rob's earlier comment, I was looking at the numbers for Insurtech. If you take the outlier out, in the UK specifically, there's only been 40 million invested in Insurtech in the UK. So if you think of that as one of the most talked about industries, it's quite interesting. So if you think about the waves of insurance, and I think of it as a generalist technology investor who happens to have an interest in insurance among other verticals, it's an area which rightfully is having a lot of share of voice because it's a huge industry which has been late to move online for a lot of reasons, mostly being that incumbents are relatively slower and you need them to participate to be able to be successful. So we've seen advantages with Bought by Many through that kind of partnership. And as I kind of step away and think, I'm not a specialist Insurtech investor, I'm a generalist technology VC, but you can look things through pretty standard lenses. So we're looking for amazing teams. Amazing team definition changes by sector. And in this sector, actually, industry expertise is quite key, whereas in others, it's probably a disadvantage. So I find actually there can be advantages through not being as close to an industry, because you can kind of see some of the trends that have worked well in other areas applying quite well to an industry which hasn't yet been through that change.
Thank you. I just want to give the audience the opportunity also to ask questions, if there are any.
Shout?
Yeah, maybe you shout. And I repeat the question. Here we go. Easier like this.
So just want to get your thoughts on Guevara shutting shop yesterday. And so from an insurance company, as a strategic investor, obviously insurance companies are very reluctant to risk and don't like failure. How do you think you would then sell future investments onto those companies, taking into account that that's happened?
So I think failure is good in general, not for the individuals that have to go through it the first time, but eventually they may look back and have a different view. We don't know what's going to happen. But if you don't try to innovate in an industry, you won't fail. So I know that when we look at ourselves in our investment process, if we've not seen enough failure, we're worried that we're not taking enough risk. And you need to take risk to make changes in industries. So although it's a disappointing outcome, it's the side effect will be there's people who have experienced a few years of building a business in an industry that is ripe for change, and maybe that skill would be used in other areas and create a different success story.
Yeah, I would agree. As well, I think I'd turn the question around and ask the insurers to think about their methodology and their approach and to put themselves in a position where they're failing, because it's not something that insurance companies are used to doing. But for innovation to be successful, there needs to be a change in mindset, a change in culture, whereby insurers are willing to embrace some of the innovation that's coming, try some different things. Not all of them are going to work, and that's okay. But certainly, we work with a lot of B2B business models, and that's very challenging to drive if there isn't buy-in from the insurers.
I mean, just finishing off on that, so I think insurers seem to have a lot of appetite to put some balance sheet up, and sort of Munich Re talk a lot about we'd like to have the problem of losing money that actually matters to us, which would be 50 million or more. That would be the sort of problem that Munich Re Digital Partners want to see. At the same time, we see, I think, for Guevara and for many others, that when it comes to the pricing discussions, then when they're trying to work with insurance partners, they end up with pricing that is just not market. And that is changing, which is good. But these companies will not be able to get out there and learn unless they can have pricing that is competitive in the market. And I think that's why you saw them, and you're seeing other companies going off and trying to get their own insurance licenses, which is, as a VC, I hate. It's 50 million to try and find if you have product market fit. That is not an investment we like to take. We'd much rather companies get going on someone else's balance sheet and learn and get product market fit. But that's not possible if the pricing isn't competitive.
It goes, we basically had this literally debate at Bolton's office the other week, right? As what does it take to actually make changes in this industry? I think if you go back to your question about what's the first wave, most of them were basically, like, with no disrespect to any portfolio companies, like just skating on the surface of the marketing, right? If you look at fundamentally what people are selling now, by and large, the same products that people were selling 40 years ago, just distributed online. And if you take those same products and now distribute them on mobile, it hasn't really changed anything, right? And the fact that I don't have to go look in a folder to find my policy documents, they're in that same phone, again, like, it doesn't really change anything. Where you really do it is you've got to get into the pricing of it, right? What is the risk model? What's made everyone get excited about InsurTech now is the wealth of data that is coming on that will give you a useful perspective to price that risk. I now know, that it's in the course of your everyday business, right? Like whether it's a Uber driver who suddenly needs insurance. Like, I know you're working right now. I know where you are. Maybe not in the next few weeks, yeah? Bad example. But, it's kind of in the course of the business. You know exactly what somebody's doing, and you're getting lots of data that helps you price it. How do they drive? Or if it's a cargo container going, what's in it, what's moving, how much did it get shaken? And I think that's what gets interesting. But if you have to go to an underwriter who spent 30 years building risk models the same way, with minor tweaks here or there, who gets paid a bonus this year for making it work this year, like, it just sounds like hard work to them, right? Like telling them, actually, usage patterns are going to change. In 5 years, the market will be different. That's really hard. And that's where I think, like, you do end up with kind of, and that's why it's been sort of binary in terms of how people invest in the insurance space. All the fundamental changes have been by companies, basically, I think, who've raised big chunks of money. Raise enough to get a balance sheet, raise enough to run their own risk models, raise enough to be licensed, and then you get to decide, right? And if you think this bit of information here is critical in pricing that risk, you can try it. I think that's where it really gets interesting.
One of the reasons why we look at the later stages in insurance, so not so much at the distribution level, is that insurance is not a sexy product. And I don't see it becoming sexy, so I want to see the iPhone of insurances, but I believe that you're still going to buy the insurance, then you want to put it somewhere and forget it. And if you put it in your phone or if you put it in your drawer, it doesn't matter. It does not become more interesting because it's cheaper or nicer or quicker. So you as a customer, if you're looking at B2C, you're not starting to interact more with your insurance contract because someone made it better. So this is a fundamental way of looking at insurance. So far, I have not seen it becoming more sexy. Yeah, you can buy it quicker and cheaper, but the product as such does not become an iPhone.
Thank you. So if we now look into the second part of the panel looking forward, what are the trends? Where's InsurTech heading? If you imagine, Malcolm, if you imagine a scenario where artificial intelligence has pulled together all your insurances in one place and automatically detects the changes in your life and adapts your coverage accordingly, and you basically just have to opt out, like this perfect world in the future. How far are we away from this? Where are we right now?
So I think people are inherently lazy, and that is a trait which I love, and I think it applies to a lot of the most successful businesses, Deliveroo, Uber, etc., etc. I think the better startups get, the lazier people become, and in a world where you don't have to worry about need to haves anymore, it becomes nice to haves that become automated for you. I think eventually there's a world where you could see that happening. In the waves of some of the innovation that's happening in insurance, we talked about the first wave, which is around where you need less incumbent intervention, which is on the distribution side. And we have seen people using wallets, essentially, to gather information on you as a way of helping you keep track of things and maybe a path to the vision of being perfectly lazy. So why not? If AI is all about collecting information and making decisions so you can focus on the things that are really important in life, I think that would be a great, nice world to be in.
Thank you.
2 years.
Rob, you once wrote that there are 3 schools of InsurTech, the first being the concierge, second the bundling, and third the pull. My question is that still valid, or would you like to modify that?
I think the model still stands. I think we're learning more about each of those. So I think the concierge model is the GetSafe or WeFox or AI model, the Broly model, that you rely on a tech company to look after your insurance for you, and they put it all in one place. And I think we've discussed this already, that actually it's been hard to get the insurance companies to work with the tech companies on this, and then you're seeing the tech companies going off and building their own insurance in one way or another. Safe announced this week. WeFox did it some time ago. So you're seeing these people trying to build their own insurance because the pure concierge layer is actually really hard. The second, the bundling still stands. This is the selling insurance at point of sale. That is a big thing already and will continue to be a big thing. The question for a startup is, how do you change that in some way? What are you doing that's really different to the people who are out there already, the Insurions, Assurance, people like that? And then the third one is the pull model, that you get people just to love your insurance and they come to you. And the best thing on that is to read the Lemonade blog. They are the most high-profile attempt to build a pull insurance that people love. And so far, the data is really early. They've sold $430,000 of insurance at a loss ratio of 130%. So the jury is definitely still out on whether the pull model can really work.
Thank you. Yeah. Before we go into the investment thesis discussion, are there any questions from the audience?
Thanks. Just got a question on speed of investment returns. Given that for most parts, the insurance buying cycle is once a year, that makes it a lot harder for a company to be able to grow customers and grow quickly. So how do you feel as investors in terms of the time periods you look for returns on your investments versus things outside of insurance?
Once a year is actually quite good. I'm a fintech-focused investor. We're investors in Nutmeg. People change their wealth management provider probably once in their entire lives. So insurance, where there's a yearly cycle and where Money Supermarket and others have educated people to shop around every year, it's actually quite good compared to other areas in financial services.
Yeah, as a general comment, I think, and certainly we're allowing for this in terms of our fund duration, we expect the returns to come in over a longer period than you might traditionally expect compared to the more general tech sector. I think one of the challenges that companies are addressing is moving away from this annual cycle, because insurance doesn't need to be static. And as we start to use the power of big data and artificial intelligence, the solutions will change to address that. So yeah, maybe that will speed things up.
I think the question is not how often the customer changes the insurance policy, because it's hard for everyone. It's hard for incumbents. It's hard for startups. I think the question is how much you spend on that customer. And I think in Insurtech, it's all about finding the right channels to get the customers and trying to embed your products somewhere and to try to find scalable channels. You either should go through brokers, where you win one broker and get 2,000 of customers, or you should go through point of sale, for example, what Schutzklick does, or Simple Insurance in Germany, where they just embed their insurance policies on the websites. Like when you buy an iPhone, they say, do you want to insure your screen for free for 6 months? And if you say I do, you have to transfer all your insurance policies to them, so they become your broker. So that's, again, a very efficient and scalable channel. And then I think, again, those companies will be bought because of their customers, and it costs incumbents for 400 to 500 euro to get a customer. And some insurtechs do that for 30 to 50 euro. So it's like 10 times difference. I think that's the key.
Just to add slightly to that, if I were to distill down what was the single most important thing that I'm looking for if I'm evaluating a business, is that the business model can be viable. So that's the customer acquisition cost, and then that's the lifetime value in comparison. And what we have seen actually with a lot of the distribution businesses, which is the first wave, is the margins are so thin, to Rob's point, that they don't give enough margin away to some of the distributors, that it's quite hard to make a viable model unless you have very unique or very smart route to market. So I think that's quite important. So fundamentally, that's the thing you need to be able to show, that either you can have a strong case behind why you think you can build a viable business and justify investing into growth, or you need to start thinking about another way of going to market.
Yes, that's maybe a nice transition to, as you've already said, to what kind of attributes or characteristics you're looking for when investing, when doing your due diligence. Maybe I would propose that we do a quick round of the top 3 points that kind of describe your investment thesis in Insurtech. Maybe we can start with you, Mike, if you don't mind.
Well, I think it's very usual in all the venture companies, and same thing applies to Insurtech. First of all, is the team. I think it's kind of obvious. The second thing is about the business model, product market fit. I think you always have to look at the companies that make something sustainable, and that they have a very good ratio between lifetime value and customer acquisition cost. And the third thing, I think, is the competition. I like companies that do something unique, and that's quite hard to and have high defensibility of their solution.
I would actually, those are the same 3 for me. And then it's how you differentiate yourselves between others who are fighting for the same amount of capital. So if you think about, as a VC maybe does 10 to 15 new investments per year, and try and see a multiple of that before they make an investment, it's showing some level of differentiation and protecting some of the points that Mike raised.
I think the one thing I'd add is the why now question. Why is this segment that you're going after? Why do they need something different? And why are they willing to change? Particularly in an area like insurance, where people tend to be fairly conservative. What is it that's pushing them to change?
So in order not to repeat all that, we are strongly believing in that we are going to see things coming down the road in the very, very near future that will have dramatic impact on the prices of insurance. And that's basically how the insurer chooses the risk. That also means that not everyone will be able to get insured by the same company, which might change the market dramatically in some of the insurance lines. But I fundamentally believe that in these kind of technologies that will have the strongest impact on choosing your risk, that will be the most driving factors of the transformation in the industry. So basically the industry ticks by combined ratio. So whatever you have in costs in the company, you divide by the premiums or the other way around. Yeah, and if you can influence either of those dramatically, then it's going to change very, very deep.
So I'll give a general comment and then two specifics. We have the first one is interesting. We haven't spoken about the geographic impact of innovation, and I mean we have an office in London and east and west coast of the US, but certainly from our perspective, if we just have a Western view, then we're going to miss a big chunk of innovation within insurance. So we're launching an innovation lab in India at the moment, which will go live by the end of the year, because we see Asia as a key center for development. I mean, quick example, I mean, Zhong'an is unique, obviously, given its shareholder base. But when you look at the big tech companies and how long it took them to reach $1 billion of revenue, Amazon, Google, those types of guys, 4 to 5 years on average. Zhong'an in China has got to $1 billion in 18 months. So an indication of the pace of change. And then specifically from our perspective, where we're focusing from an investment thesis, so we're very interested in the life and health space and the convergence of artificial intelligence, genomics, and health tech, and driving a shift away from protection to prevention, being able to understand individuals' specific risk characteristics and profile, and insurance becoming about giving those people access to the right levels of technology to enable monitoring and intervention at exactly the right time. And we're looking at things which turn on its head mortality rates and the likes with some of the cancers. So I think that'll be a fascinating space. And then the second area is around commercial lines, so commercial insurance, which I mentioned earlier. We're very, very cautious on direct-to-consumer propositions. So focusing on commercial, we're doing a deep dive at the moment on marine insurance, where we see some interesting things happening with analytics capability at the front end, potentially combined with blockchain at the back end. So yeah, we'll continue to focus on a number of product verticals within commercial lines.
So I'd call out, I guess, a theme we like, a trend we see, and then there's one thing about the teams in particular. So one, I guess, area we're looking at a lot is everything around cyber security now. Equifax being the most recent thing, but there's more and more of these. If you start thinking about connected cars, connected pacemakers, like James Bond assassinations will look different in the future, right? If someone just hacks into the car and drives it off the cliff with no guns and no car chase. But, it's risks like that, I think, that are popping up all over the place. So we made an investment in an encryption business called Tanker, we're about to announce another, next month we'll announce another thing in that space, and potentially a third the month after that. So cybersecurity, I think, is a big thing, because it's this whole other risk dimension that people haven't really thought about. And I think also the insurance industry is trying to get their heads around it. And it's also a nice one because you're well aligned, right? So if you take something like, I don't know, auto insurance, like lots of the issues is with fraud, where your customer is lying to you, potentially. Whereas on the cyber side, it's you and your customer basically against the bad guys. So that's one theme we think is going to be very interesting. The second big thing, I guess, is just this shift from insurance. I think in the end, like, most people don't care about insurance, right? Like, I don't know, I'd go stronger than Rob on well, let's call it a specific example, but can you make insurance something interesting enough people want to spend time on it? I think actually, like, most people really don't care, right? What they care about is not having to worry about some stuff, right? Like when you're, when my first daughter was born, that was the point someone should have hit me for life insurance. This risk pops up you didn't think about, and you get them. And I think that's what we're kind of seeing with more and more of insurance, where it gets plugged into other workflows. So in the process of a transaction, I don't know, with a Chinese business on Alibaba, you're worried about credit risk, shipping risk, and can you weave an insurance proposition into that? So again, people don't need to think about it, but they know there's that layer of protection built into it. And then I guess in terms of the individual teams, like the one thing I'd say we look for that maybe didn't get called out is like sort of people who are just crazy enough to think they can actually turn over the whole industries. Like that's actually always a lot of fun, right? So yes, some track record and so on, but yeah, it takes a certain sort of degree of insanity to like go over all these established norms, and that's usually the guys who actually go and do it.
Thank you very much. We have 2 minutes left for a last question.
I have two, if that's okay. First, following on from your comment, Sam, how much would the panel value Zhong'an at currently? And second, there's a graphic downstairs that says that 2/3 of insurtechs are technically retail, and I'd say about 90% of the media commentary is around retail insurtechs. How much of your time and your money are you looking at personal lines versus commercial lines insurance, and what's the trend in your view on that?
First question, way past my stage. It's worth a lot. Second question, 100% of our money is in B2B or commercial lines businesses. That's not very much money yet, but it is all in there, and I agree there's a lot of interesting things to happen there.
Just on the first question, I'm not giving investment advice, just so we're clear. I'd invest in Ping An rather than Zhong'an.
So we do not differentiate between personal lines and commercial lines. We're looking at everything. We're just at the beginning of our investment cycle in that area, so we will going to be open for both of it.
Okay, then, yes, thank you very much for making the time and sharing your insights. I think it was really interesting. Thank you so much.